Are you tired of the issues with third-party patient financing, giving up 10 to 15% of your fee when they approve someone that has perfect credit and could probably pay you cash if you didn't offer them a no interest option? And if you're a PPO practice and you use third-party financing, you're taking as much of a 30% hit or greater on your UCR. Patients getting denied access to financing. A lot of our practices will say that about half of their patients or less even qualify for third-party financing. And that doesn't even include the patients that make up excuses. I need to go home and think about it and I'll be back, in fear of being declined for some sort of financing. And then if you do find a finance company that will approve a patient with less than great credit, they're typically making you take a 15 to 20% discount to get your money up front and charging your patient somewhere between 20 and 36% interest, which is a ridiculously high interest rate. Introducing compassionate finance. It's the in-house financing for patients that third-party finance companies don't want you to know about. And the reason why they don't want you to know about it is because it's much better for you and your patients to finance them in-house. So why in-house financing with compassionate finance is better for you and your patients? Well, every patient with a checking account can qualify. Your practice will control the automated decisioning process. You're going to increase your cash flow by doing more comprehensive treatment and avoiding paying third-party financing fees. You get on the right side of interest. So instead of taking a discount when someone needs a payment plan, you now get you earn your full fee back plus up to 18% interest, depending upon your state. And your practice gets to determine what interest rates and payment terms are offered to patients. And your patients and treatment coordinators are going to be happier when you offer CF. No more awkward conversations about money or patients leaving without treatment. So how it works is patients can apply from multiple places. They can apply from your website, they can apply from our website, or they can apply directly at the point of sale in your office. You can establish a payment plan with a patient in literally less than a minute. You can start a new application, continue an existing application, or estimate payments with a patient. And Compassionate is going to protect you from offering payment terms from people who are not payment worthy. So Compassionate Finance will look at not only the credit, but more importantly, the checking account to verify, is this their checking account? Do they manage their money well in their checking account, right? Or we're looking for someone who hasn't overdrafted, doesn't have overdraft trends or anything like that. Again, someone who manages their money well in their checking account despite their credit. And there's a lot of things that go into credit that don't necessarily determine your ability or your propensity to be able to pay back a payment plan. We're going to recommend that you get a down payment to cover your hard costs, right? Like, let's say if I come into your practice and I need 5 crowns and say your lab fee for a crown is $100 for simple math, you need $500 down, right? So we would recommend get a down payment of $500 to cover your hard costs. The rest that you have at risk is just your time, which is very valuable, but it's much better than doing just what the insurance is covering and just doing 1 or 2 crowns. It doesn't take you any more time to do all 5 as it does to do just the 1 per se, right? And if the patient has insurance, you're very easily able to use their insurance as the down payment that you need to cover your hard cost. And then once they're approved, you can allow patients to choose any term that they're comfortable with. So payments as low as $40 a month or up to 60 months for amounts greater than $15,000. It will show a 72-month option. You can either turn this around, show it to the patient, just ask them to choose. You can ask the patient what kind of payment they're looking for, or you might look at this and see, at 12 months, it's $110 a month, and ask the patient if they're comfortable with that, right? Or the 6-month option for $213 a month. We're very big proponents and advocates of free choice. Ask the patient what's comfortable for their budget every month, because they're going to tell you, and that's going to increase the likelihood of them paying it back on time and paying it off. And the longer that they need to pay it, so say this instance, they needed 36 months to pay it instead of 12 or 24, you're going to make a lot more money in interest. There's multiple ways to sign. Once they've chosen a payment option, they can either sign right there with their finger or a mouse. You can also click send for signature, where it'll send a request via email to the patient to sign the contract electronically, where all they have to do is click on the email, click twice to sign, and then the process is done from there. And then we manage every aspect of your installment plans for you. So we're going to automatically collect the payment from their checking account every month. Remember, we vetted their checking account to determine if they manage their money well, and you give them a payment that they were comfortable with. So we're going to automatically pull that payment from their checking account every month, turn around and directly deposit that payment into your bank account on the following Friday. Past due accounts, if they miss a payment, immediately we're also retrying it within 5 days, but immediately we're doing phone calls, emails, text messages. We're performing that follow-up for up to 90 days. And again, we're just trying to let them know that, hey, we're here to help you. Don't let this be turned over to a collection agency and reported to the credit bureau. We can help. We're very successful in that process. And I'll show you some statistics in a moment. Our customer support team is US based, they're all bilingual speaking, and 97% of our calls are typically answered within the first 30 seconds when someone calls in. So we're very high touch. You don't press 1 and 2 and 3 and 4 for a bunch of different things to try to get through to someone. You're able to call in, press a prompt, and get right a hold of someone on the team. At the end of 90 days, worst case scenario, if someone say just doesn't pay at all or doesn't make a promise to pay, right, some sort of commitment to pay when they're past due, then at the end of 90 days, we will update the account to efforts exhausted. It's up to you what you do with it at that point. You can turn it over to collection agency where they'll probably report to the credit bureau. The collection agency that we've partnered with that we can refer to you, if you reference compassionate finance, they're only going to take 20% of what they collect. If they don't collect anything, they don't take anything at all. Here's a revenue projection scenario. So this is assuming that you have one location and you're able to help 4 patients per month with compassionate. Now that could be 4 patients that you weren't helping that were currently walking out the door, that when you were only offering, say, like a third-party financing option, or maybe it's just 4 patients in general that you're financing. But again, let's assume that this is treatment that you're not currently doing. Let's just use an average treatment or procedure amount of $5,000 with a down payment of $1,500. Average interest rate 15.9% for 30 months. Estimated default rate is 13%. Now these last 3 numbers are averages at Compassionate Finance. And then you can see here in the chart below where it shows monthly origination. So if you're doing this 1 a week, for $3,500 financed amount through Compassionate, you're basically putting $14,000 a month on a payment plan under the monthly origination column. And then you can see over there next to that, the average monthly income. So you see where with Compassionate, your monthly income builds up, right? So obviously you're receiving the monthly payments, but as you're doing more and more, the monthly payments are building up. And as you'll notice, around year 2 to 3, right, with an average term of 30 months, by month 30, you're bringing in what you're originating every month. So you're bringing in a little over $14,000 a month in just monthly payments from Compassionate, and you're originating $14,000 a month. So at that point, you are literally receiving the same amount of payments every month as you're putting out there in new payment plans. And on an annualized basis, you can see where if you were to do this for say 5 years, you're bringing in $178,000 a year, and you brought in a total of $670,000. If you were to do this, say between now and retirement, maybe retirement for you is 10 years, 15, 20, or 30 years, you'll notice that this can pay very significant dividends from helping, again, 1 extra patient a week that would have walked out your door anyway. And if you retire anytime, after the 30 months, you're going to have about another $264,000 that you would earn in retirement from balances that are just going to be paying you down every month. And then let's look at a comparison. So with Compassionate, you're able to treat more people, make more money. If you look at this, let's say with Compassionate Finance compared to third party, which isn't really apples to apples. It's really kind of apples to oranges, because with third party financing, you're very limited, right? Those finance companies, those lenders, they're really only looking to approve the patients that have excellent to great credit, right? They're not really looking to approve someone that has average to bad credit or no credit at all. So let's assume with Compassionate, you're able to help 4 people a month. With third-party financing, because of their approval ratings, you're only able to help about 2 a month. You take a 10% discount to get your money up front. With Compassionate, let's say that the average default is 13%. So about 13% of the dollars that you put on CF are likely to default at some point along the way. But if you look at this, even with a 13% default rate built into it, by year 2, you are literally bringing in $9,100 a month, which is way more than that you would be bringing in with third-party financing. Because again, third-party financing is limiting, they're only cherry picking who they're approving, number one. So with CF, you're able to do more dentistry. And then with third-party financing, you're also taking the discount as well. So as you can see here, by year 2, Compassionate Finance is an absolute no-brainer option. You just have to get, you have to just come to the understanding that this isn't instant gratification. This is just like starting your practice or any other business. You're making an investment of your time. You're getting down payments to cover your costs. You're in control of your financing. You're not letting, we're already letting insurance companies dictate the patients that we're able to treat, right? How many times we have patients that ask, well, can I just do what my insurance is going to cover, right? Well, insurance doesn't cover very much. So it's really hard to do the dentistry that people really need and want when we're letting insurance and finance companies dictate that. So by offering Compassionate, you're able to take control of that and really start doing the dentistry that you want to do, right? Bigger procedures that are much more profitable, they're better for you and they're better for the patient. Here's another revenue projection scenario. So we looked at that, $5,000 treatment, $1,500 down. We're assuming you're maxing out insurance. We know most of our customers, 9 times out of 10, they're using the insurance as the down payment to cover their costs, which covers their lab fee and a good bit of their time as well. A lot of our practices are getting more in down payments than what they were producing per hour from a dentistry perspective. So an average term of 2.5 years, average monthly payment of $142 a month, and you can see in the top right that you would earn $764 in interest on this. CF over the 2.5 years would take $408 to manage it, and you don't know our fees, but we only get paid if you get paid. And so you would basically net out after our fees an extra $355 in interest. So if you look down below, again, which one would you rather have? Would you rather have, almost $3,900 paid out over 2.5 years at 15%, where the patient got a reasonable interest rate? Or would you rather have nothing from third-party financing because they would have probably denied this patient altogether? And then, third-party financing, subprime, that very hard to find. And again, the very few that are out there, they're charging, extremely high interest rates to patients that are honestly ridiculous. But even then, you're taking about a 15 to 20% discount. So we stayed conservative at a 15% discount, which here would be about $2,900, so just under $3,000. So that's a $900 difference between compassionate and even a subprime lender. If you could find one that would approve someone. Here's our company performance from 2011 to Q2 of this year. We helped over 61,000 patients get care that they need. 240 million in treatment was provided to those patients. 180 million was managed by us. We're currently managing 54 million of in-house financing for our dental practices. The average credit score, or what we call Vantage score, was 590. So again, most people are, using compassionate to kind of supplement their care credit option, which is fine. A lot of them do. We see a lot of practices where over time, as they're building up their payments with CF, they start to get rid of that third-party financing and they only offer CF. Our practice has got 60 million in down payments, have been paid out 114 million in principal, 29 million in interest. The performance before CF fees is 99%, meaning our practices are receiving 99 cents on the dollar before CF's fees. Now that's after a 13% default, right? And so after CF's fees to manage everything, which work out to be about 6%, the net fees paid out to our practices, our customers on average are receiving 93 cents on the dollar. That's better than if third-party financing would have approved all of these patients, right? And again, the average credit score of 590. So, again, that's a really good argument for why you really should use this as your only financing option for patients. And what's interesting too is that of the people who ended up defaulting and just failing to pay altogether, they paid back 33% of their installment plan before they end up defaulting. So, the average payment plan is $4,500, which we've actually seen that go up over the years. But I think that's really driven by a lot of implant and cosmetic dental practices that are really more attractive to CF because they are trying to do the bigger cases. And, on the bigger cases, it gets very difficult, as for those of you viewing, that are doing implants and more full mouth dentistry can relate to, right? If you're asking, a lender to give a patient 5 or 10 grand or more, it becomes very challenging because it's an unsecured loan, right? It's not a home or a car loan where there's some form of collateral. Our practices on average are getting about 25% down. And again, that's driven by insurance. You've got, insurance usually will cover anywhere from about 20 to 25% of the treatment need. Average rate 15% with an average term of 37 months. The pricing, I'll go over it real quick. We have a $1,500 one-time setup fee. We've been waiving that since COVID. We're going to continue to do so. We just want to make it easy for you and lower the barrier to entry to